Hello, everybody. Charlie Gipple here with CG Financial Group. If you are a numbers geek, a finance geek like me, then this is the best gift that Santa Claus could ever deliver to you. And I come bearing gifts. This is an internal rate of return spreadsheet. So within this spreadsheet, I have the formulas for the internal rate of return. Here's the thing. In investments, the goal is to put your money to the best use possible, right? And what defines the best use possible with one's money? It is to have the highest return on that money, right? Now, I'm not just talking about the return, I'm also talking about the return taking into consideration time. Now, what do I mean by that? Well, let's take this. You go to my trusty internal rate of return sheet, and let's say that you put in $100. The cash flow is negative because you're taking that out of your pocket and putting it in. So you put in $100. Now, if you got back at the end of year one or year two, $103, for the mathematicians out there, what kind of return is that? What kind of return is that? Using this scenario here and the time of just 1 year, it's really simple, right? Your return, your internal rate of return is 3%. You put in 100, you got back 103. By the way, isn't this cool? The taxable equivalent, if that return of 3% were otherwise taxable at a 40% tax rate, it would need to be 5%. So that after that 40%, you get 3%. 40% of 5 equals 2%. You deduct that off 5%. That's 3%, right? Or you can change that. Let's say 35%. It would be less of a taxable equivalent. You get what I'm saying there. Now, the point is would you prefer $103 1 year from now or $106 2 years from now? Now, for those that don't understand what I'm talking about when I say time and time value of money and how that works, one should say that they prefer $103 1 year from now. Why is that? Because let me ask you a question. What rate of return would be required for that $100 to turn into $106 2 years from now? Is it 3%? No, it's not 3%. It's less than 3%. Why is that? Because, well, let's take 3%. $100 growing at 3% is $103. That's our year one value. But then if that $103 grew by 3%, 3% on top of 103 is actually more than $106. Why is that? Because of compounding. So that means that taking into consideration time, i.e. the internal rate of return, would actually be less than 3% on this example. And by the way, if you wanted to check your math, do $100 compounding for 2 years at 2.9563%, and what you would have is exactly $106. Now, the point to all of this is many of the products that we deal with today show, cash flow going in, and then many, many years later, or cash flow going out, I should say, from the client's pocket going into a particular policy, then many years later, cash flow coming in, whether it's a death benefit or whether it's the client cashing out of a policy, whether it's an annuity or what have you. And how do you know if that's good or not? How do you know if it's good or not? In other words, if I were to give you $105 5 years from now or $108 8 years from now, which one would you prefer? Which one is better from a number standpoint, from a putting your money to the best use standpoint? I don't know the answer to that off the top of my head, but my internal rate of return calculator would tell us that, right? Now, let me give you an example. Let's take the internal rate of return on a death benefit, for instance. Let's say that you're funding a policy at, I just had this recently from a good friend of mine. He's an agent, but also a client on this particular policy. He's going to buy it for himself. He says, here's what I want to do. I want to fund a policy to the tune of $3,000 a month or $36,000 per year. I forgot something there. That's a negative. $36,000 per year, because that's his negative outflow. That's what he's paying in premium. $36,000 per year for 20 years, he says. But then he says, let me ask you a couple questions, Charlie. On that policy, what type of death benefit will that buy? What type of death benefit will it buy? And I'm just kind of pulling numbers out of the air here. I don't remember exactly what it was. But let's say in that 21st year, if he were to pass away, that the death benefit going to the beneficiary would be $2 million. That means that this life insurance policy is able to generate an internal rate of return to the beneficiaries of 8.9691%. And if that beneficiary was in the 35% tax bracket, well, that would be a taxable equivalent of almost 14%, right? He goes on and asks me another question. He says, what is the cash value based off of this policy? This was an IUL policy, but the potential cash value was $1 million. So Charlie, if I were to cash that out in that year, I would be able to get $1 million, right? That is correct. You'd be able to get $1 million, albeit it wouldn't be tax-free, because if you cash it out, well, I won't go there. That's for another topic. So it won't be tax-free, but again, I won't go there. So that means that the internal rate of return on your cash value, again, taking into consideration time, that 21 years have gone by in which you've paid premium, and also 21 years have gone by since you got that $1 million. What would the internal rate of return be? Would be 3.03%. And by the way, that is much more involved than, well, $36,000 times 20. Let's see, that's $720,000. And I'm getting back $1 million. What is that? So that's like an internal rate. Is that an internal rate of return of what is that? Like 35% or something? No, because you do not get on your $720,000 that $1 million all within a 1 year period of time. So you need to take into consideration time, which means your internal rate of return is actually 3.03%. Now, when do I use this report the most? When I use it the most is when I'm looking at, well, obviously future cash flow. Let's say you put $100,000 into an annuity today. Then I'm going to give you a complicated concept here that you'll understand by the end of it. We're going to talk about loans on life insurance and stuff like that. But for instance, let's say you have an annuity, and that annuity is, you dump in $100,000. What would you prefer? 10 years from now, a cash flow from that annuity of $5,000 for the next 20 years, or would you prefer cash flow of $4,500 starting out, increasing each year up to, say, $6,000 over that 20-year period? Which one is better? I don't know which one's better, not by thinking about it, but I can tell you which one's better from an internal rate of return standpoint once I punch those numbers in. This tells you which one is better from an internal rate of return standpoint. Now, this particular friend of mine, he says, okay, so, there are certain folks out there that would tell me that, if policy loans are available, say like at the end of year one, for instance, what if I turned around after paying my $36,000 premium and took a loan against the policy and got cash in hand, say to the tune of $10,000. He said, what would that look like? Of course, because I have a loan on the policy, which means that my net cash flow, $10,000 coming out, but $36,000 going in, which means that my net cash flow would be negative $26,000. So if I do that every year, yes, it is going to reduce my ending value, because loans and the interest, the principal amount and the interest, reduce the ending cash value. But he says, what would be a better use of my money? Keeping that $36,000 in there premium per year, or pumping in $36,000 and then taking out $10,000? What would give me the better internal rate of return? Well, it depends on what that cash value looks like at the end, right? So that cash value in this example, I want to say it reduced to like $600,000. And by the way, remember what our internal rate of return was by not taking those $10,000 loans against the policy. It was just a tiny, tiny bit over 3%. In this example, because those loans and everything reduced his cash value down to $600,000, What does the lower internal rate of return number up here tell me? What that tells me is that he, for each dollar that he takes in loans, he is paying more of an interest rate on those loans than what he is earning on the collateralized value in the policy, right? So there are a lot of concepts out there that are marketed very good, and there are a lot of concepts out there that are marketed wrong. Some of those concepts that are marketed wrong go something like, take loans against a policy as soon as you can. Why? Because that money is still in there working for you. Well, yes, the money is still in there working for you, but also there is the principal amount working against you in the form of interest that the insurance company is charging on those loans. And the fact that the internal rate of return here being less than that 3% that it was tells me that the loan interest rate is higher than the rate in which this particular policy is performing at, right? Now, what if instead that cash value, it's still reduced from the $1 million that he would have had he not taken any loans against the policy. It's still reduced, but let's say it only reduced to $900,000. Now you have a different scenario, right? Now you have an internal rate of return that's higher than that 3% internal rate of return, as if he never took a loan against a policy. This tells me that maybe this is a better use of that money, right? To take a loan against the policy. Why? Because maybe that's cheap financing. Because this tells me that what is being credited within that life insurance policy is more than the interest rate that is being charged for the loans that this particular person took against that life insurance policy. This is how I am able to gauge, say like there are a lot of, well, yes, there are a lot of whole life insurance policies, obviously, but dividend rates, say a 5% dividend rate on a whole life insurance policy versus a loan rate of 5%. Let's say 4%. Does that mean because the dividend rate is 5%, because the loan interest rate is 4%, does that mean that by taking loans against the policy as quickly as possible, does that mean that you're going to have the positive internal rate of return or a better internal rate of return versus if you just left it alone? Not necessarily. Not necessarily, because dividend rates, I wouldn't say dividend rates don't matter, but if I were to give you a dividend rate of, say, 6% on top of a particular value that had been eroded because of upfront charges and all that stuff, a dividend rate of 6% may not outweigh the interest that the loan is charging of, say, like 4%, for instance. I know that's kind of complicated, but there are some carriers out there, some whole life carriers that say, we don't even declare a dividend interest rate. Why? Because the rates are kind of a moot point, because the rates are on top of what? If a value has been eroded as a result of upfront loads, charges, expenses, and stuff, that interest rate doesn't mean anything. What matters in the end is what is the illustrated value. To me, what matters in the end is what you put in versus what you get back. And thus, a function of all of that is the internal rate of return, or the internal rate of return is a function of all of that, I should say. Hope that makes sense. It is a little more Finance 303 type stuff. My point is just know that there are a lot of cool uses with this internal rate of return report that has the functions, the formulas embedded in this. Again, Charlie Gipple with CG Financial Group. Have a good day.